The signs of a housing crisis in Australia were evident even before the pandemic. In the post-COVID years, chronically lagging residential construction combined with massive immigration caused real estate prices and rents to soar. This created a cycle where prices rise because more people invest, and more people invest because prices rise. Exactly the kind of self-perpetuating loop that Nobel Prize-winning economist Robert Shiller described as speculative bubble. But what if I told you there is another major factor that has been deepening this crisis for decades? Hi, my name is Dr. Alexey Konashevich. Welcome to my channel. Let's get straight to the point. The real issue is the overregulated financial industry, which fails to offer Australians better investment alternatives beyond real estate. A tangled web of bureaucratic financial regulations stifles investment in productive sectors like technology, manufacturing, and services, forcing capital into real estate. This overheats the housing market and creates a macroeconomic imbalance. It's the elephant in the room that no one seems to acknowledge. What's even stranger is that I couldn't find any substantial research on this issue. It baffles me that neither academia nor government bodies seem to have investigated this fundamental question. How well does the financial system perform on a macroeconomic scale over a long period? Has everyone forgotten that the purpose of the financial system is not to enrich speculators, but to serve as the lifeblood of the economy? Its role is to efficiently allocate and distribute financial resources across various sectors. When one sector, in this case housing market, is inflating beyond control, it signals a serious systemic issue. Yet, the financial system is often treated as a given, rarely questioned or scrutinized at this scale. Once I asked a friend who runs a small but successful business in Sydney about his expansion plans. Why didn't he consider securities like bonds, credit funds in the market? Or attracting shareholder capital? Why did he choose the franchise model instead? I already knew the answer, but his response confirmed it. He told me that, in theory, expanding own business would be far more efficient, but issuing financial security is just too complex and expensive. The process would require lawyers, financial advisors, brokers, tax consultants, and accountants, an unnecessary burden. A franchise, on the other hand, is simply a contract. No need for licenses, no need for an army of intermediaries. The downside, of course, is that expanding via franchising depends on finding motivated entrepreneurs who will actively grow the business, not just passive investors. Please keep this idea in mind for a while. We'll discuss this in a moment. Meanwhile, securities and financial markets remain largely inaccessible for businesses. New South Wales Chief Justice Thomas Bathurst once explained that while legal regulations are necessary for economic efficiency, excessive complexity increases compliance cost and creates uncertainty. He put it best.
An individual should not need a senior counsel, junior counsel, and a small army of solicitors to tell them what the law they must comply with is.
Let's look at the numbers. 58% of household wealth in Australia is tied up in non-financial assets, mostly housing, compared to a global average of 46%. 66% of Australian families own property, and more than 20% of these own multiple residential properties. These figures don't just reflect a market trend, they highlight a regulatory environment that restricts financial innovation, leaving real estate as the only viable investment option. A well-documented economic pattern shows that when investors face high uncertainty or barriers to entry in alternative markets, they flock to safe assets. A study by the Mercatus Center found that complex regulations stifle entrepreneurship and redirect capital away from productive industries. There is a misconception that plenty of financial investment options exist. You can buy shares even in your banking app, right? Well, yes, but it's not enough. Financial products remain expensive to operate and less profitable than real estate investments. If financial products were as easy and accessible as real estate investment, we could balance the economy, but there is a problem. Creating a financial product security requires an expensive and complex licensing process, legal teams, and regulatory approvals. Operating in financial markets requires another license, essentially a license for a platform where people buy and sell it. Financial advisors must have high-level expertise and difficult-to-obtain licenses. In stark contrast, we see investment advisors for real estate shouting from rooftops with no need to hold a financial license. Of course, real estate agents hold their professional licenses, but their qualification requirements are incomparable with AFSL.
Never overpay for your property. The first step to growth is to work on your mindset. Investing well.
The housing crisis isn't just about undersupply of residential property and undersupply of financial products as an alternative. It's also about how Australian laws restrict capital from flowing into the broader economy, exclusively favoring real estate. Consider this. In financial markets, regulations explicitly limit who can invest and how much. Financial regulations has created a segregated class of qualified investors, sophisticated investors, with exclusive access to a closed, privileged market of financial products. Let's compare two real situations. James is selling a 32.2 million property in Bondi in Sydney. He can offer it to anyone, no license for the property, no registration with a regulator, no restrictions. Mila runs a successful robotics education business, Thinkloom, operating across 6 Sydney suburbs. A TV show even featured her story. If she wants to raise the same amount of capital through financial securities, she faces enormous hurdles. She needs a financial license to issue either a wholesale or retail security. Wholesale investment is easier, but it's limited to sophisticated investors, drastically reducing her options. Retail fundraising requires a prohibitively expensive retail financial license. Her last option is a so-called small-scale offering, but this allows her to raise only up to 2 million. Sounds not too bad, right? No, there are strict limits, a maximum of 20 investors. And she may not advertise it like James. She may only make personal offers within 12 months, quietly and through word of mouth, as if it were something illegal. Sorry, Mila, investments are not for real businesses, only for real estate. This imbalance has distorted the investment landscape, giving real estate an unfair advantage. Financial regulations have grown increasingly complex over the decades, but new technologies could allow for simplified and standardized processes. Regulations could be streamlined to remove unnecessary licensing requirements, making financial markets more accessible. Instead of requiring costly lawyers and brokers, a structured, automated system could facilitate investments, smart contracts on blockchain. But that's a discussion for another video. On my other channel, Blockchain State, I explore blockchain technologies, discussing how next-generation financial tools could compete with the old financial system, if only regulations allowed it. Unfortunately, ASIC's latest Info 225 update proposal makes it clear. They see no distinction between traditional finance and fintech, meaning new crypto technologies remain subject to the same rigid, outdated rules. And just like that, Australia's last hope for a balanced economy is being snuffed out. If Australia truly wants to fix the housing crisis, we need to fix the financial system first. Until investment rules allow capital to flow freely into productive industries, real estate will continue to dominate and the cycle will continue. What do you think? Is Australia's financial systems overdue to reform? Let me know in the comments. Subscribe for more insights on the economy, innovations, and regulation. See you in the next video.